We've priced in a lot of market exuberance, and really even after the V-shaped recovery from Liberation Day, we've done probably almost 10% on the S&P, almost 12% on the NASDAQ. And it's interesting, you're talking about the Dow today. We kind of sometimes make fun of the Dow as an index because we think it's the way it's calculated makes less sense to me. That's not what we're here to talk about. The point is that small caps, equal weighted, Dow, so not semis, not the high end of the tech outperformed today on this sense that you really got reaffirmation from some of the data. The data being a bizarre jobless claims number. Excited to talk to Rick Santelli and get his interpretation of some of that. But I don't think today's CPI was a great number if you're someone that wants to see inflation tamed. I mean, I think we actually saw some goods inflation that's seeping through. I think we know that services inflation is sticky. I think we have a higher kind of inflation paradigm right now, better than at least higher than where the Fed wants to be. And I think all the liquidity that have markets going to the moon right now, and that's almost every market, especially even credit, is something that should give the Fed some pause, even though the labor side of the mandate, we all know, is getting all the attention right now. So markets have priced in a lot of Fed. I think markets have priced in more than the Fed that we now have in terms of Fed fund futures. And I think that's something to be somewhat wary of. But what a week when you think of all the earnings revisions, I think, that are coming for the tech sector based upon all the news we've had over the last 5 days.
I mean, I think the question at this point is are the markets pricing in too much Fed? I mean, you take a look at the inflation numbers. Are you somebody out there who buys groceries, gasoline, electricity, and repairs your car?
Yep.
Well, then you see inflation, and that's an issue. I mean, that's a problem for the Fed.
It's a problem. I mean, the macro is about as confusing as it's been in a very long time. You look at that June jobs report that's been revised lower. That was the first one, I think, since COVID, right? And then if you look at the CPI and you look at some of these other inflation readings, you have to kind of take into account like the cumulative nature of, this inflation is the thing. So if you have a weakening jobs market and you have inflation starting to move higher, that's a really tough spot for a consumer.
This is a current picture of inflation in the month of August for CPI and each specific, sector or variable that played into the overall inflation gauge. And as you can see, you have shelter at 3.6%, which is mortgages and rent. You have food, which went up 3.2%. For groceries, you have gasoline actually came down 6.6% over the last 30 days or so. And as you can see, continuing, because this is a theme that we've had over the last couple of years, is used car prices, used vehicle prices have went up even over 6% in a month, right? So this is an inflation gauge, and you see all the way to the left, you have the overall inflation went up 2.9% month over month. So that's something that's concerning, because we know that the Federal Reserve, inflation number that they want inflation at is 2.22%, basically, right? So we're still well above that 2% threshold. So this is something that we need to watch over the next couple of months to see if inflation is going to stay up, if we have tariff inflation, or if inflation starts to continue to come down.
Is already dealing with some of these increased prices as it relates to the tariffs and the uncertainty and how long we're going to actually be in a trade war. I mean, you got to think about this. We came into this year, it was 2.5%, basically that tax across the board. And here we are, it's about 18%. So the, as it relates to the market, though, I think, Tim, what he just said is like, there's one thing, though, that's actually working in the stock market in the S&P 500's favor, is that we see the dollar can't get out of its own way. And this whole notion that we're going to be in a rate cutting cycle, that should be a bit of a tailwind. And then you just kind of throw in this CapEx that we've seen, again and again and again. The numbers are so huge. And I think it was Apollo's Torsten Slot had this slide last week, and I think we talked about it 2 weeks ago. If the consumer's 2/3 of GDP, right? Well, that CapEx has just matched that number. So that's been a huge, huge tailwind. So if you do start to see a pullback in that and a weakening consumer, there's little doubt that you're going to be in a situation where it's going to start getting back to that R-word recession. We haven't heard that in a very long time.
I go a different angle. I go jobless claims. So jobless claims the worst in 4 years since October 2021. If you have a job, you can pay inflationary prices. Shelter costs, 1/3 of the CPI. Think about the chicken and the egg. If the Fed lowers rates, you wind up having lower mortgage rates. You wind up having lower CPI. Right. So for me, they're enforcing that higher CPI by not cutting rates. So if you could cut rates, a third of CPI comes down. Third of CPI comes down. Then you throw in transportation. You have gas coming down, used car prices. Why aren't used car prices moving down? Interest rates. So you have mortgage rates, interest rates for used car prices. Everything that the Fed is doing is fostering higher prices by keeping prices where they are right now. So double mandate, I'm looking at the job side more importantly.
We're going to continue looking at the stock market and how in this current environment, interest rates as well as CPI and inflation and everything is impacting the stock market. Let's go to the committee and see what they got going on currently today.
At record highs. Notable today, the 10-year yield near the lowest level since April. So we're watching all that with the Fed meeting on tap. Will they go 25 or will they go 50? That seems to be the biggest question because the market is convinced nearly 100% you're going to get at least 25. So Weiss, the question is, what do stocks do? That's question number one for today. JP Morgan's trading desk says this could become a sell the news event. I've heard that from others as well because the market has continued to ramp up, today notwithstanding, ahead of that meeting. What do you think?
So I think there's a real possibility, but it's not going to turn the rate cut. If we get 50, the market takes off. 25 is a base case. I think that, and what JP Morgan's saying is that that's in the market right now. I agree with that. However, it's going to turn on what the narrative is.
That's right.
That
Powell's words.
Yep.
Powell's words more than the numbers are probably what matter more than anything right now.
Right. And look, it's clear from the numbers that jobs are going away. Claims are high. Job growth is low. It's basically flat. So they're going to decide what is going to move the most. Is it going to be inflation continuing to spike up? And then they have an out. That's tariffs. It's a one-time event. So I actually think they're going to be somewhat dovish, when they go next week.
Okay, how about a dovish 25 cut? That great for the
I
market?
think it goes up. I think it goes up.
Yeah, Bryn, what about you? How do you game this out?
I think we get a 25 basis point rate cut. 50 doesn't seem to be necessary. I think we get a 25 basis point rate cut. They acknowledge the weakness in the jobs market. I think he's definitely going to get questions about the data itself, right? The 911,000 revisions we have. So I'm really going to be curious to hear how they thread that needle. I think that the market, once again, is a pull forward mechanism. So we already have this priced in. I don't think we're just going to get some rip-roaring rally. I think what's been working will continue to work. And so I think you're going to have sectors like real estate, private equity, et cetera, that will continue to be these beneficiaries of a lower rate environment. And I don't think we're going to be one and done.
I've heard, Rob, for, I don't know, like 2 weeks that it's priced in. How could it be priced in if the markets continue to set new highs? Maybe it's not priced in.
Well, there's a little bit of positioning there, too. If you look at institutional investor positioning, we're in the 58th percentile, which Deutsche Bank would define as decidedly neutral. So I agree with Steve. I think it depends on the communication that comes out with it. But it's also what the data informs from here. So short run, you might get a move. But then what does the data inform from here? And I think if the data doesn't lean towards a direction of further cuts, not a disaster where you're seeing growth that completely roll over, but just leans towards the ability to have further cuts, given the moves in stocks, given the move in specifically small caps, treasuries, gold, you could see a re-rating that's maybe more substantial. I just don't think so, because as we go into the fourth quarter, I think you're going to see a pretty big positioning chase from here. It's more next year.
Okay, that's what I want to get into. That tees it up perfectly. Like the best rate cut, right? We think we're going to get a cut, 25, 50, whatever. Your best positioning for a cut. Do you stay big or do you go small? Russell 2000 is on pace for its 6th straight week of gains. Small caps are having their best quarter since the end of 2023. The NASDAQ's up 14% year to date, and the AI trade, as you know, has been back on lately. Stay big or go small post rate cut between now and the end of the year. What do you do?
Well, I always stay big, so I'm a little bit less objective than some of our friends here.
Okay, well,
So what are they talking about? They're basically stating, should you stay big, meaning large cap stocks, right? Microsoft, Nvidia, Amazon, Apple, Nvidia, said Nvidia already, Google, big companies, Tesla, should you stay big, right? Go with the big players, right? Netflix, etc. Or do you go small caps? Right now, small caps is in the Russell 2000, which is why they showing the Russell 2000 on the screen, right? But small cap stocks are a little bit more volatile. They do well in a low interest rate environment, and they tend to run when interest rates come down versus when they go up. Those companies, those businesses struggle, and it's really based on the fact that those companies' profit margins are either they're either profitable or they might not be. They might not be even profitable companies. They have low profit margins, which then impacts their businesses as a whole. So, which is why there are more risky plays when it comes to the stock market. But some people believe that with the lower interest rate environment, those companies will do better. So the transition from large cap to small cap could be something that might be in play moving into into next year. This is the debate and the playbook when it comes to economists as well as these analysts and these fund managers on how they then allocate money. They move them from Nvidia or from Microsoft or from some of the big players, and they then reallocate them to some of the smaller cap companies so that they can see that continued growth moving forward. This is important when it comes to your investment portfolio and if you should diversify or not. I say stay with the 3 to 5 great companies that you believe in, reinvest, accumulate more shares, and ultimately, get the long-term benefits long term.
What do our friendly viewers? What should they do?
Follow me and stay big, because the challenge is moving forward. To Steve's point, if the data breaks down, then you're going to see the small cap, the more speculative side roll over.
Even with rate cuts, if the data breaks down?
I think so, because you're betting on a stronger economy. So here's the thing about the sell the news, because I thought that was a really interesting note. If we get a 50 basis point rate cut, I think that would be a sell the news event, only because from my perspective, it could be a little bit scary. Like, why do they need to do that? I'd rather see it be more of a cool glide. Like, give me 25 now and a few more 25s. 50 may spook the market.
Man, I don't know.
It would spook the market very short term. Very short term.
Consumer sentiment came out negative today.
Yeah, but I still think 50 takes it higher. Whatever the knee-jerk reaction is, it's so tough to account for. Usually it's a head fake.
How would you answer that question? Stay big or go small? We're thinking about outperformance now, right? Not what we like, this, that, and the other.
Yeah.
Outperformance between post-cut and end of the year.
Look, I would stay big because I think it'll continue to work. And if you take a long-term approach rather than trying to buy the smaller caps here, the smaller caps, they're going to be hit a lot harder by a slowing economy. And that's what we're seeing.
But why then is the Russell up 5% over the last month if the data has been showing that the economy and the job market is slowing? Well, wouldn't that be one of the leading indicators in the market that agrees with the data?
Well, these are new markets. So generally, yes, but generally the small cap starts moving, and some of the junk, I'm not saying small cap's junk, but we've seen that move also. And that typically moves. They're the last ones to move. So as you look for what's not participating in the rally over the last few years, it's small cap. We've had some head fakes on small cap. So it's a catch-up trade.
Well, you just said small caps are the last ones to move. We both know that generally speaking, small caps are the first ones to go in and the first ones to come out.
Go out, right.
So, but they're not the first ones to go in because they're not going in. They're up 5% over the last month, even in the face of data that's been a little squirrely and job numbers that just flat out haven't been good, right?
Understood. My point is the dynamics. Let me just finish the thought.
Yeah, go ahead.
The dynamics in this market, unlike any other cycle. They just are, because everything that's in index funds, because retail investors aren't really selling much on news. Some are, and creating those bottoms. But overall, people are adding to it. We really haven't seen that, while we've all been in the business. So over the last few years, it's changed. So that's what's affecting small caps.
Well, to your point then, so maybe there's full positioning towards the mega caps. And if it's 50, people say, well, I mean, there's going to be a huge bang for your buck in other places of the market finally, and then you get a rotation.
Listen, I'm not rotating out of nothing. I'm telling y'all this right now. Listen, Nvidia, Microsoft, Google, Amazon, Meta, Netflix, the AI plays, the TSMs, the AMDs, the Oracles, like not transitioning and rotating out of those names, right? Like I'm not taking profit out of those names. I'm going to continue to reinvest to buy more shares of great companies for long term. This is not a short term play. This is a long term perspective, right? This is a 10, 15, 20-year thought process.